In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll do a bit of a breakdown as to why exactly tariffs are so important and why something that's happening in the US is actually affecting worldwide markets and the economy. And in the second story of the day, I'll talk about how electricity and energy production and consumption is changing quite a bit in our world and what it really means for all of us as analysts and people who keep a track of these kind of trends. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 9th of April. So let's begin with the first story of the day. Now, I'm sure you might have heard a lot of noise right now about tariffs imported by President Donald Trump in the United States. And the thing is, people around the world right now are very worried that it might cause big troubles for businesses and the economy at large. Now, these tariffs are simply extra taxes on goods that cross into the United States, and they may sound harmless if you only think about them as a way to collect more money. But the thing is, if you look just a little bit closer at how products are made today, you will suddenly start to see why these taxes can sort of shake up the entire global economy in ways that we cannot easily predict. But to understand things a little better and a little deeply, let's first step back and imagine why we can buy so many advanced products at such affordable prices in the first place in today's day and age. See, modern gadgets and tools, let's say like computers, phones, cars, airplanes, etc., are all put together like giant Lego sets of sorts because many small parts are made by specialized companies spread across the world. Let's take the most simple example of a pencil. See, many years ago, an economist named Leonard Reed explained that not a single person alive can make a pencil completely on their own. Someone chops the wood in one place, someone else mines the graphite somewhere else, and another group altogether deals with paint and metal for the ferrule that holds the entire eraser behind the pencil. Now, it's a big collaborative process involving thousands and even millions of people, each of them handling a specific part of the job. And of course, this pencil lesson becomes massively more complex with modern items like, say, mobile phones or car batteries. A single product like that might actually be made of hundreds or even thousands of different parts, and each of them could be built by different specialists. For instance, Boeing needs around 6 million components for every single aeroplane that it makes, and Toyota needs roughly 400,000 parts for its cars. Now, all of this works because these businesses form enormous global supply chains, with each supplier focusing on only one tiny thing, which is making it cheaper or better than anyone else can. You actually might have a company devoted only and only to making one specific spring that goes into the accelerometers that are used in mobile phones. Now, that one tiny single part may not really look too important if you look at it in isolation, but if something happens to that supplier, the entire line of expensive products can actually come to a halt. And when a crisis like a global pandemic or say a new set of tariffs hit the supply chains, it can completely break it down in many surprising ways. We saw a glimpse of this during the COVID-19 pandemic when people across the globe started working from home and the demand for laptops and computers suddenly shot up. Chip manufacturers shifted their production to meet this surge, meaning they were not making as many chips for cars as a result of it. And once car makers wanted to pick up production once again, they suddenly found themselves in a chip shortage of sorts. Now, this very tiny component, which is chips, suddenly became a big roadblock and global car production slumped by 26%. And that is because even though these chips might be very tiny, you just cannot produce a finished vehicle without them. And therefore, prices obviously soared. Now, the exact same thing here could also happen to a small capacitor that is just worth some pennies. Basically, if you're missing it, shipments of expensive phones or computers get stuck in a bit of a limbo. And that is exactly why experts are panicking when they are seeing major changes to trade rules. Trump's tariff could cause even more chaos. American tariffs make it more expensive for companies worldwide to send goods into the United States. The idea behind these tariffs is that manufacturers will decide to pick up their factories and move them all to America, which in turn creates more jobs there. Now, in theory, of course, it sounds like it makes sense because you stop cheap goods coming from abroad and local firms might decide to build everything on American soil itself. But the thing is, in practice, it's not that simple. When we talk about, let's say, players like Apple or Nike, what we are doing is not just talking about one single company that can one fine day pack their bags and move to a different location. What we are talking about are huge chains of factories and suppliers that are spread across several different countries, sometimes even even crossing borders many times before a product is completely finished and sent to us as end consumers. For example, consider something as basic as a car's dashboard. It actually might start production with metal frames that are sourced in Canada, stamped and shaped in Mexico, then shipped to the United States for assembly with electronic components from South Korea and chips from Taiwan using software written by engineers in India. And the plastic shells that are used here could actually be molded and painted in different facilities, sometimes also in multiple countries, before everything gets finally sent back to the United States for its final assembly. Now, of course, as you may understand, this complex back and forth across borders can happen repeatedly for each of the 1,000 parts that go into one single car. A 25% tax slapped on every cross-border movement would very quickly make the final product far more expensive and would force businesses into messy scrambles to reorganize. Now, that kind of massive reshuffling takes time, money, and planning, and in many cases is just not feasible. Now, what this means is that imposing tariffs does not only hurt foreign suppliers. American manufacturers, who also rely on global supply chains for their raw materials and parts, now suddenly face higher costs as well. If you basically run a factory in the US, which is making cars or aeroplanes, you still need to import things from different places across the planet. Now, those higher costs either end up being passed on to the consumers that you have, or they become an expensive burden on businesses like yours that just cannot adapt overnight. Even if some companies try to bring manufacturing into America, they would need an entire ecosystem. Basically, it's not just about one factory moving in, but also the hundreds or thousands of smaller suppliers that feed it. Now, of course, setting that up from scratch or relocating it from other countries is an incredibly long and complicated process. Many people are alarmed because tariffs risk disrupting a system that has been slowly built over decades, where an entire reason for lower costs and higher efficiency is that each part of this chain is handled by the place that is best suited for it. You can almost think of it like a huge relay race where each runner is covering just one section of the track and is passing the baton along seamlessly to the next runner. And in this case, if you suddenly include new barriers or taxes, you trip up one runner and it threatens the entire race altogether. Basically, businesses do not know what will happen to prices, whether they should start hoarding parts or if they should pay for expensive facilities. And that uncertainty alone can cause delays and panic buying, which then leads to more volatility in prices and supply. Like I said, during the COVID-19 pandemic, one small shift in how chips were allocated managed to unsettle the entire global car market for many years to come. With something as huge as tariffs on a wide range of imports, it is not hard to imagine the level of chaos that could be on a much larger scale now. Anything from raw materials for steel frames to tiny electronic components can all of a sudden become a choke point in global supply chain. So in simpler words, the main fear right now is that these new trade policies could upend a delicate system that keeps our everyday products flowing smoothly at prices people can afford. Trump's tariffs might succeed at raising taxes on imports for sure, but they also risk jacking up prices, creating shortages, and driving some companies completely out of business. The end result is a world where our daily needs, things like phones, cars, laptops, and much more, could actually become much harder to make and much more expensive to buy. None of us, of course, have a perfect way of knowing how exactly all of this will unfold, but when you look at how easily one small missing part can shut down entire production lines, it is very clear why everybody is currently confused and worried. And that is why you see alarming headlines where people are saying that modern supply chains are fragile and they could snap under pressure. With that, let's move on to the second story and talk about electricity, specifically from the findings of Ember's latest global electricity review for 2025. Now, this, let me tell you, is not just about energy in general, which can come from, say, coal, oil, wind, the sun, or even uranium. But instead, it's about electricity, which is the secondary source of energy. Now, this, for your reference, is what we do not pick up directly from nature, and instead we create it by converting those primary sources that I just mentioned into an electrical form. Now, this distinction is important because the paths and trends that we see with electricity can be very different from the broader story about energy in general. Now, what the Global Electricity Review found is that worldwide electricity demand jumped by 4% in 2024. And at first look, of course, 4% might seem like a very small number, but it's actually the third highest annual increase that has ever been recorded, which makes it quite a big deal. China played the biggest role here by increasing its electricity use by 6.6%, and that alone accounted for more than half of the entire global demand growth. India's demand, on the other hand, rose by about 5%, while the US saw about a 3% increase. Now, some of this, of course, is because people are buying more appliances and industries are working harder, but the year was also historically hot, as you might know it, and extremely heat sent air conditioner uses soaring, which obviously added to the overall demand. Heat waves last year were also so intense that they made up nearly one-fifth of the total growth in electricity usage. And if you look at that 4% growth and remove the effect of record high temperatures, then last year's growth would not look too much different from the previous years. Even so, there is a bigger shift happening in how we use energy. More things that once used to run on diesel or petrol, let's say like cars or water pumps, are now going electric, and electric vehicles are becoming much more common, cutting into oil demand. Diesel generator or pumps are gradually being replaced by electrical versions as well. And on top of all of that, we have the rise of AI models and data processing. Now, for your context, running large language models or even mining cryptocurrencies requires a lot of electricity for computing and data storage. And these newer demands alone have pushed up global energy usage by around 0.7% last year, which is sort of double the boost that they gave just 5 years ago. And if we move on and quickly talk about the supply side as well, the good news is that renewables are growing much faster than they have done ever before. In 2024, for example, for the first time since the 1940s, clean sources such as solar, wind, hydro, and nuclear made up more than 40% of global electricity generation. Renewables alone added a record 858 terawatt hours or TWH, which beat the previous high by almost half. Solar power is the leader in this trend here, which has grown by 29% in 2024 alone, and it has now doubled in capacity across the globe in just the last 3 years. The world installed 585 gigawatts of new solar capacity just last year, which is 30% more than what it did in 2023 and more than twice the capacity that was added in 2022. We crossed 1 terawatt of solar capacity in 2022, and then we managed to double that in just 2 years, which is basically a rate that we have never seen with any other power source. Now, of course, capacity here refers to the maximum possible output, and we often produce lesser electricity than the nameplate capacity might suggest, but still, the pace of growth right now is almost breathtaking. It's also become so cheap to set up solar panels that entire new markets can now pop up very, very quickly. A great example of this is Pakistan, which saw electricity costs shoot up due to older, expensive thermal power contracts. For your reference, in just 1 year, Pakistan doubled its solar panel imports, reaching 17 gigawatts, and they transformed themselves into one of the world's fastest growing solar markets. But that said, even though solar is definitely surging, fossil fuels like coal and gas still step in to meet any sudden spikes in demand. When heat waves struck in 2024, China and India burned more coal and the United States turned to natural gas. The review that I'm referring to here also mentions that if we hypothetically had the same temperatures that we had in 2023, global fossil fuel generation in 2024 would have hardly increased somewhere around 0.2%. Now, this situation sort of creates a loop where global warming brings more intense heat waves, which then pushes up electricity use, especially for things like cooling, and that can lead to more fossil fuel burn, which therefore can feed back into further global warming. But still, coal, hydro, and wind continue to play a large role overall. Coal alone accounts for about 34.4% of global electricity production, which is especially important in countries like China and India when power needs surge. Hydropower is still a very big contributor at about 14.3%, but it can vary quite a bit because rainfalls are not always consistent. Wind power, on the other hand, accounts for 8.1% of global electricity, and while that is still growing, wind speeds in some parts of China and Europe were not as strong in 2024, which slowed growth a little bit in those regions. So looking ahead, we see that renewables are on a path to outpace fossil fuels by the end of this decade. Big countries like China and India are ramping up their solar and wind industries, and better energy storage systems are making renewables more reliable year-round. The capacity that is being added every single year to capture solar or wind energy is growing so very quickly that it is matching and in many cases even surpassing the growth in demand for electricity. And this means that the clean share of electricity, which has already passed 40% by the way, could become an even larger chunk of our total power generation in the very near future. And all of this suggests that the way we power our homes and businesses is changing real time. Clean technology is now at the front line of economic growth and energy security, so to speak. Fossil fuels still fit in the gaps when the weather goes crazy, but it is very clear that with every new solar panel or wind turbine, we are more and more leaning towards sources that do not generate carbon emissions. As Phil McDonald from Ember puts it, clean tech, not fossil fuels, is now the driving force of economic development. The era of fossil growth is coming to an end. And for people who follow trends like these very closely, this is sort of a moment when renewables have finally taken center stage. And for anyone new to this subject, it is like a sign that the world is sort of shifting towards clean power at a faster pace than most of us have ever imagined. That brings us to the end of the two stories of the day. With that, let's move on to the final section of the day and talk about the quick news headlines. First, after a gap of 34 months, the centre has raised excise duty on both petrol and diesel by 2 rupees per litre effective 8th of April. This brings the special additional excise duty to 13 rupees per litre on petrol and 10 rupees on diesel. But despite the hike, retail prices will remain unchanged as oil marketing companies are expected to absorb the additional burden using existing inventories. Second, Shriram Finance Limited, which is one of India's largest shadow lenders, has approached the RBI for a primary dealership license with plans to set up a separate entity for this purpose. The move comes as India's sovereign bond market continues to expand, with the outstanding amount of federal government bonds reaching 112.5 lakh crore rupees as of April 7th, according to RBI's data. Third and the final one for the day, Apple exported iPhones worth 1.5 lakh crore rupees from India in FY 2025, marking a 76% year-over-year jump and doubling its committed target of 74,900 crore rupees under the government's PLI scheme. The company accounted for 75% of India's total smartphone exports, which crossed 2 lakh crore rupees in the latest financial year. Monthly shipments averaged 12,500 crore rupees, with March alone contributing 20,000 crore rupees, which is Apple's highest monthly figure, followed by 18,000 crore rupees in January and 17,500 crore rupees in February. That's all the news and stories I have for you today. I hope you enjoyed the show. This is your host Anurag Bansal signing off. Take care and I'll see you tomorrow. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.